Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are talking about, give my financial opinions, most likely around wealth, around commodities, or financial topics. We're going to dive right in. And again, if you want to follow me, it's at finding_finance, or you can sign up to the website, use the word discount in the coupon code, get yourself a little bit of a discount, and go to the question and answer sessions there. And we talk about individual stocks and all that type of stuff. So Brian Gates says, the harsh truth, we're using more oil than ever. Global oil demand hit new record high, passing 102 million barrels per day. Oil demand will increase 3 to 4% in the next 5 years. So global oil consumption rose more than 100 million. We're at 102 a day during the first 4 months of 2023, for which detailed data is already available. Wait, I thought Kathy Wood said that we were going to crash and that oil demand was going to go straight lower. How did she get that so wrong? And how is it so easy and obvious to a lot of others that the oil demand was not going to crash? Well, it's probably because we have existing cars, probably because the electric vehicles are not even selling. They're not even offsetting the growth yet in the sales of cars yet. I mean, they're offsetting the growth, but they're not actually eating into and having a impact on the growth of the expansion of the ICE vehicles. So ICE vehicles are still growing. They're not shrinking yet. And I think it's going to take some time before that actually happens. Okay, so I just thought this was kind of an interesting information here. It says almost 60% of women on Bumble were willing to consider a man who was 6 feet tall. That number dropped to almost 30% for men 1 inch below the 6 foot threshold, and below 15% for men 5 foot 8 inches and shorter. On the opposite end, men who were 6'5" met the height requirement of nearly 90% of women. So this is filters set in advanced filters by females using by height. I am 6'2". That's how tall I am. Not that it really matters. My brother is 6'5.5", 6'6", somewhere in that range is what my brother's at. So it looks like he's got more potential options than I do. You got to play the cards that you're dealt. And if you're 4'11", you're going to have a rough time. It looks like if you're a guy and 4'11". If wind and solar are so cheap, then why are China and India building so many new coal power plants? Coal demand continues to hit record levels in 2023. China permitted the equivalent of 2 new coal plants per week last year. Lots of coal is needed to fuel these coal power plants. They need a lot of energy. That's what they need. Now, I read through this. I would say this is basically how I did it. It says how to build wealth the safe way. Work a 9 to 5, save 25% of your income, invest your pay raises, own assets you understand. Don't try to look the part, don't wear your wealth, repeat for years, and you'll become a millionaire by 40. That's basically what I did. I did exactly what this person said, almost to the T. I work at a large company. I save a good chunk of my income. I even saved greater than that when I first started working because it was just me. I invest my pay raises. I own assets. You understand. I don't dress very expensive or anything like that. You can see I'm just wearing a regular red shirt today, and I don't really care to spend much money on any of that stuff. And you do that for years, and all of a sudden you're going to be at that area by that age. U.S. Treasury 10-year yield rises 15 basis points on day. So if this holds, it will be the biggest one-day rise on 10-year yields this year. And it's a massive up day today in the 10-year yield. And the 10-year yield prices assets, and it's a wrecking ball when it goes up 4% in a single day. It is a wrecking ball, and it goes around and hits all these different assets, pulls them back down. And I think this is somewhat surprising the markets. The size of this move, the speed of this move is surprising the markets because I think the markets think that rates are going to go down. And they were pricing in lower rates. And I think it caught everybody off guard. It caught me off guard. I'll tell you that. It says men who can both be right and sit tight are uncommon. That's where you want to be, guys. You want to be right and sit tight. That is the ultimate end goal. That is how you get the big returns, the very big returns. You have to be right and sit tight. Now, here's the problem. Being right means on the long-term time frame. You will be wrong a lot in the short-term time frame. So what a lot of newer investors get confused is that you can be right on the long-term time frame, and it will look to be wrong and feel wrong in the short term. So we just rode through a short-term pullback in commodities, and those commodities looked to be wrong in the short term. And right now, the way that I did it is I sit tight. I'm right on the long term, but you have to look past the short term pullbacks if you want to play the big picture game. So, I mean, that's the way I view it. And those short term pullbacks and the volatility in the short term, I think is really rough for a lot of individuals. And commodities, they're very volatile. So it is one of the hardest sectors to actually sit tight in because it's so volatile. We've got Petrobras board meeting, Petrobras board to discuss new dividend policy on Friday. I'm interested to see what their new policy is going to be. Hopefully it's a big payout. JP Morgan sees an opportunity in gold ahead of a likely U.S. recession, predicting prices will push past $2,000 an ounce by the end of this year and rising to fresh records in 2024 as interest rates start to fall. This is where we're at in the cycle. Now, what's difficult here is, are the homes going to be in a surplus, or are the inventory levels going to remain low? If the inventory levels remain low, we could cycle down with interest rates and then we go back up, much like the 2000, 2001 bust, which I think could be likely. It could be likely that that happens. So if we're in that part of the cycle, the yield curve will uninvert, and that's what's going to push gold prices and silver prices upward. As we saw yesterday or today, yesterday if you're viewing this, because I'm recording this 7/27, not 7/28. If you look at the interest rates and what interest rates have done, they rocketed higher and they pushed gold prices lower. We have to see how sustaining that really is going to be. If we get a sustained move in yields to the upside, gold will be held down for a while longer, I think. And it'd be a great time to accumulate if it holds gold and silver down. Now, I'm not stating that's what my opinion is. I'm just stating that if yields do continue higher, it will hold gold and silver down as that yield curve kind of finishes its move of the inversion. Market Sniper says, for those celebrating silver's slam down today and the dollar's current strength, on the day after the BOJ and Fed spoke, you are here in the TG pink circle. Good luck. And what he thinks is going to happen is that this is the gold to silver ratio. He thinks this is the right-hand shoulder. We're going to have three movements up and down. We're going to get one last move higher, and then we're going to break to the downside. What he's saying is that move in yields is temporary. And that very well could be the case. I don't know if it's temporary or not. He doesn't know it either. But that is what his experience and his technical analysis is saying. It says, for those celebrating silver slam down today and dollar's current strength on the day after the BOJ and Fed spoke, you are here in the TG pink circle. Good luck. Meaning we have one last move higher, a very small move in the gold to silver ratio, and then he thinks that we're going to break down. A disorderly descent, XAU appreciation, XAG fast appreciation, where silver outperforms gold in a move higher. That's where I think it's going to be. Definitely, I think that's going to happen. Should you pay off all bad debt before investing? My answer is yes, if it's bad debt. If it's your mortgage and it's a 30-year fixed rate at a very low percent, I wouldn't consider that bad debt. I would consider that your ability to control inflation through payments of your living situation. You're either paying off a house or you have rent. And I know a lot of people, they're like, well, I don't want to buy a house. I'd rather rent. I can tell you this, guys. I decided to purchase a house when the prices were pretty low. I refinanced, and my mortgage right now, just the mortgage, is 1/4 the price of rent. 1/4. And I am not subject to the increases of rent. I purposefully bought a house to get the heck out of paying rent. And I knew that, well, in my opinion, when I was looking at it at that time, I said, house prices are going to appreciate and rent is going to go up. We are going to get squeezed here. And I did not want to subject myself to increasing rental prices. And I don't like renting because they can kick you out. What are you going to do if you get kicked out with like a 2-month notice or a 1-month notice and there's no homes to rent? Like, that is very stressful for me. And I found that to be some of the most stressful times is when someone said, you need to move out in a month or two. And that's all the heads up they gave me was like 2 months. I got stressed to all get out because, man, I really just, I didn't want to be put in that situation. I had a really bad person I was renting from. It was a female. She owned a condo. And in the rental agreement, she wanted me to pay for appliances that basically wear out. And her place was like 10 years old. She went through one company before, and the before company, she switched companies that wanted to go to this new lease. I read through the full lease, and then I documented everything that was bad with the place before signing the lease, and I handed it in with existing conditions. And she did not like that because under the old lease, she wasn't fixing some of this stuff. So she tried to do that on me. And I documented it all. She tried to charge me, and I said, you know what? You can't charge me. This was all existing in the lease before that. And she couldn't charge me legally. She also tried to charge me on a broken what was it? A dish what's it called? Garbage disposal. And that's part of the plumbing. And by law in Colorado, you're supposed to handle all plumbing problems. And she tried to charge that, and I was like, you know what? This thing's like 6 years old, 5 years old, or whatever. I looked at it at the date. I was there for 4 or 5 years when I was renting back in the 2010 in the what was it 2010s? Yeah, I was in the 2010s, and she tried like putting all these costs on me, and I'm like, dude, I'm like the best thing. I'm not destroying your place. I pay on time. I have zero complaints. Like, what the heck? I hated that. I am never going back to renting a place again. I absolutely despised it. And that was not just that one renter. There was other ones that were just a pain in the butt. They wanted you to clean on their schedule, on their time, and doing this. It's like, screw that. I don't need that in my life. Here's Happy Wine. He says, if the monetary policy lag is 12 months, then we have only felt 250 basis points of the 525 basis points of hikes so far. If the lag is 18 months, then we haven't felt any of the hikes in the real economy yet. That is important, and there is a lag here. So we could be feeling some of these rate hikes starting at any time now, and that it could be restrictive, and we could have problems. We could have a slowdown. We very well could. I am not in the recession camp. I'm not in the deflation camp, but I'm also not in the camp that it can't happen. We'll look at our stuff. We'll measure it, and if the yield curve starts to uninvert, then at some point in the future, maybe 6 months, 12 months, or something like that, it could happen. We could get a recession. If it's not driven by the real estate market, we'll see inventory stay low and everything will just be stuck. If it is driven by the real estate market, then we got to get out. And if inventory is rocketing higher, then maybe it's 18 months to 2 years out that it occurs. It says gold is a proven safe haven, and copper is a base metal that usually does well in good economic conditions, aka Dr. Copper. Look at the move during the inflationary 70s. This ratio has consolidated the 70s move before for 40 years. It now looks ready to run again. So this is the inflationary 70s. In 1970, we had a commodity bull market that was flashing a buy signal off the ratios. That was the commodity to stock ratio. 1970, boom, we had a housing crash in the middle of this. In 75, a housing market crash. Boom, that was caused by the housing market crash. And then we rocketed again with another inflationary wave from the real estate market. Boom, 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 boom. Big home builds, big expansionary phase, and then a basic move over here was that disinflationary declining interest rate environment. What we have now is that breakout to the upside of that 40-year downtrend in yields. That break in the downtrend, we can see that it's having an impact on the gold to copper ratio. What I think is coming and what he thinks is coming, and I agree with him 100%, is that this green shaded area is going to occur on this right-hand side. We're just early still. We're very early for all of this. This chart is confirming that viewpoint. It's confirming that we have something changing. That's why it's a shoulder inverted, and why we've got the 70s big move here. You could even say that this is a big cup and handle. Here's your cup, and here's your handle. That's also what silver has, and it's also what gold has in some of these ratio charts. If that's the case, a very big inflationary outcome is probably coming for whatever reason. And if that does come, we could see gold outperform copper in a big way. We could also see silver and platinum do some crazy stuff, which I hope occurs because that's where I am located with a good bulk of chichinga, we'll call it. It says, why is including your car in your net worth such a controversial topic? If it's worth something, it should be counted towards your net worth. I agree. There are also a lot of collector cars that are actually worth a lot of money. I would include some of my cars in that. If they're worth 40, 50, 60, $70,000, well, that's a pretty big chunk. It's a pretty big chunk. So I think you should include anything that counts towards your net worth in a net worth calculation if you were to sell it. Would you rather have $100,000 in real estate profit per year or $100,000 in dividend income per year? I would rather have $100,000 in dividend income per year. Why? Because of the hassle factor. And depending on what your returns are, another way that you want to calculate this is if you got lower, if let's say it was a 2% dividend yield, that would mean you have a larger amount of net worth, because on a 2% yield, in order to get 100,000, it's 100,000 divided by 2% would give you, a good chunk of money there. If this is being made at a higher return on your capital, maybe it's 15%, then I would definitely want the dividend income because you have a larger amount of money invested to generate $100,000 of dividend income. And so, one, you've got a larger net worth. Two, you've got more money. Three, it's less hassle. So that's how I would do it. It says nothing about this being an equal amount of money invested. It also, and if this was equal, I would still want the dividend income because I don't have to do anything. I don't have insurance. I don't have to worry about hail damage on a house that you have to fix. Uh, just you have a lot of problems with tenants potentially destroying property. I know a lot of people who've rented homes out, and a vast majority have had problems with people that they've rented to. They've destroyed homes. They've had to go to court. They've had all these problems. There's a house that was rented a few blocks away, and they completely destroyed that house. We're talking probably $50 to $100,000 of damage. They destroyed like everything. They put holes in the wall. They put holes in the kitchen, in the bathroom. The only thing they didn't really destroy was the outside of the house. But all through it, I mean, they just destroyed all sorts of stuff. And I don't know what legal ramifications that person's going to do. I think the guy who owned the house, he just sold the house. He's like, get me out of here. But yeah, what do you do if someone's completely broke and they can't afford to live there and they just destroy your house? I don't know what happens. Here's Seabridge Gold Investor. It says gold ETFs to halt outflows this year as U.S. rates peak, UBS says. This morning, Bloomberg reports that investors are about to return to gold-backed ETFs after shunning them for months. A consensus grows that U.S. interest rates are approaching a peak, according to a UBS analyst. UBS added that inflows into ETFs backed by the metal will turn positive in the fourth quarter, in their opinion. Willis forecasting that gold will climb toward a record high in 2024 as they see the U.S. Federal Reserve relieving markets with the 25 basis point rate cut in December. The move back in ETFs is likely to give further boost to bullion, which has been climbing despite the lack of support from the investment vehicles, notes Bloomberg. So that's their opinion. That's also the same opinion that we read up above from Market Sniper. Are rates going to peak here in the short term? And short term, I don't know, but I think these guys are right on a longer term time frame. The rates will uninvert whenever that is, and then we are going to see a big tailwind behind precious metals. So that is the market conditions that everyone should know inside and out if you're a gold and silver investor. When does gold and silver go up? When does it go down? It goes up when the yield curve uninverts, when those yields come back down. That's the fear trade, the safe haven. That's why it's labeled the safe haven. So we've got Gary Savage here. He says, it's going to be a battle for gold against the banking cartel from here to the all-time highs. The Fed is pumping liquidity in the banking system or sector to prevent a collapse. They need to try and prevent that liquidity from leaking into the commodity sector and igniting inflation again. The proven strategy is to suppress metals, the canary in the coal mine. As long as they keep gold suppressed, the rest of the commodity sector tends to remain contained. However, gold completed its 8-year cycle low last fall, and the cartel has been slowly losing control of the metals market. Eventually, gold will retest the all-time highs for the fourth time, and once a breakout occurs, the suppression will completely collapse. The price will start to rally aggressively. In my opinion, they're not suppressing the price. Well, if they are suppressing the price, they're doing it through interest rates. When interest rates start to uninvert, that is when this is going to rip it. It's front running that potential move is what it's doing. It's front running. So I don't think they're necessarily, they might be actively suppressing it through interest rates, but that is the mechanism they're doing it with. I don't think they're doing it through suppressing the price directly in the gold market. I think they're doing it through interest rates if they're doing it. That's why they're raising rates. They are actively trying to suppress it through rates. So I don't think that he's necessarily right up here. I think maybe perhaps he doesn't know that it goes up during a uninversion of the yield curve. And I'm not trying to say that by any mean substance, but maybe he does know that, maybe he doesn't. I don't know. But that's when gold generally takes off. And we're getting very close to that from that time to occur. COMEX registered silver inventory plunged by 3.1 million ounces, 9% of the total registered stocks today alone. Morgan Stanley, residential housing is the world's largest asset class and a central driver of monetary policy and the business cycle. And this is what is driving. It's residential real estate. This is where all the loans are coming from against it. It's the credit expansion. He is 100% right here by making that statement. But that's where I'm going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Again, these big picture views that we see on these markets, they all point to higher pricing. There's a lot of gold and silver here. I should say it's gold related, all pointing to a higher move in gold. So yeah, that's everything looks good. Maybe we eke out a little bit more interest rates to the upside before this market is done. Maybe it goes on for a couple of years. No one knows that for with any sort of certainty. I do think that we are in an area where everything could rally, could potentially rally. I know others. They're showing charts. It's the lead-in pattern. They think it's going to be a head and shoulders. I don't think that's necessarily right. Somebody posted that in uranium. I think that's a lead-in pattern that's going to move higher. Baltic Dry Index has it. Oil companies have it, and they're all breaking to the upside. They all roughly have that lead-in pattern. So, yeah, that's my opinion there, and that's all I've got. So that's all I've got for today. We'll catch you next time. This is Finding Value.